Guys, welcome to the meeting. This is a wonderful webinar with our fantastic partners, Mutual Trust. And the Chalkboard is extremely excited to be partnered with Mutual Trust. We love the products that they have. We love the people that they have brought to us to train. And we're going to take about 30 to 45 minutes today and go over a special set of products that I don't think anybody really has had the chance to get to know. So let's just hand the table over here to these fellas to give us some real good information today. Please take notes.
Thank you, Chris. My name is Luke Cosme. I'm the Chief Marketing Officer for Mutual Trust Life Insurance Company. I also have Kip Walker on the line with me. He is the Regional Vice President for your organization with Mutual Trust. So he'll be your primary source of information, your primary contact as well. Kip, introduce him to your voice.
Hello, everybody. Thanks for joining us today.
Yep. What we want to do, as Chris said, is go through a little bit on us, give you a little bit of our background on the company, what our story is, because we don't have the name recognition that some companies do, but we've still got a really great story to tell about our history and how we've gotten to where we are today. Then what I'd like to do is go through our product portfolio at a very high level. And focus in on one specific product that we just introduced a couple of weeks ago. And actually, Chris got introduced to it in the last couple of weeks as well. It's a unique product in the marketplace. It's going to give you the ability to talk about something that you might not have been able to talk about before. And, as all of us being salespeople, something different is always good. So let's just go ahead and start. You look at that first slide and you see all the people coming together in the design there, and you'll see Mutual Trust crowdfunding since 1883. We call this that because there's been some talk in the industry and in different conferences that we go to about this idea of crowdfunding websites like Indiegogo or GoFundMe, Kickstarter, and that they have the potential to disrupt the insurance industry because you can bring people together, they can donate money to help someone. And I find that argument both ironic and sad. Ironic because there's really no purer form of crowdfunding than a mutual life insurance company. And I find it sad because we've done such a poor job as an industry of talking to people about what we do that they feel they have to go to these sites to get that type of benefit. I heard a stat the other day that on GoFundMe, 40% of the websites on GoFundMe are bereavement sites. So it's for people who've had a family member pass away and they're trying to collect money to help that family survive. And when I see a number like that, and I think go out there and see some of those sites, it's a real stark reminder to me of all the opportunity that we have to talk to people about the good that we can do. It says crowdfunding since 1883 because we actually got our start in 1883 in Galesburg, Illinois. So the precursor to Mutual Trust was an organization called the Scandinavian Mutual Aid Organization, or Scandinavian Mutual Aid Association, excuse me. It was a group of people that got together in Galesburg, Illinois in a Lutheran church. And they got together because they recognized that if the breadwinner in a family in their community were to pass away, it's going to devastate that family and have an impact on the community as well. So they pooled their resources together and created a pool of funds where if a family member passes away, that family could go to that pool of funds and take out an amount of money to help that family survive. They looked at it and said, this is going to help us. It's not only going to help that family, but it helps the community. It helps the businesses that they go to. It helps keep the community alive, and keep everything moving. So about 20 years later, a subset of that group got together in Chicago, and this had worked so well for them, they thought, you know what, we could do this for other people too. So they scraped together the $100,000 that it required to incorporate a life insurance company in the state of Illinois and got their incorporation, got their charter as Scandia Life. And Scandia Life opened its doors for business in 1904. The first thing they did as an organization was refund that $100,000 to every person that gave it to them because they wanted an organization that was owned by the policyholders. They did not want something that had outside interest, outside shareholders. When you work with a mutual company, your client is number one because your client is an owner of the company. When you work with a stock company, who comes first in a stock organization? The shareholders, right? That's why a stock company exists, to increase shareholder wealth. So if the shareholders come first, at best your clients are number two. They wanted to make sure it was an organization owned by the policyholders so that the policyholders were the top priority. Well, they took that responsibility very seriously. And over the course of the 20th century, there were a lot of different examples of how a mutual company helps its clients. For example, during World War I and World War II, like most insurance companies, we charged additional premiums for war risk. After the wars, we refunded every dollar of additional premium that was charged back to the policyholders because, again, they are our owners. During the Great Depression, when FDR declared a bank holiday in 1933, a lot of people, they couldn't get their money out of the bank, so they turned to the next source that they had, which for a lot of them was their insurance company. We met every single obligation that we had during that bank holiday to give people the money that they wanted. Fast forward, through the entire 20th century, and we did what a mutual organization is supposed to do. We shared the success of the organization with the owners, who are the policyholders. Mutual Trust has paid a dividend to its policyholders every single year since 1909. Now, we can't guarantee that we're going to pay one next year. Legally, they won't allow us to. But if we've paid one for 109 straight years, there's probably a pretty good chance we're going to pay one next year. Would you agree? So let's get into some of the details of Mutual Trust today. So fast forward to 2015, we merged with Pan American Life Insurance Group. It was the first mutual holding company merger in the United States in about 12 years. What that did for us is we became the U.S. Life Division of Pan American Life Insurance Group. We became part of an organization that is now more than $6 billion in assets and more than $1 billion in capital and surplus. Why are those numbers important? It puts us we're right in the middle. We're a medium-sized life insurance company now. We used to be a small company. Now we're a medium-sized company. And that billion in capital and surplus means we have tons of runway for growth. We don't have to worry about how we fund the operations and fund our insurance growth like a lot of mutual companies do. We have a ton of runway to fund that. Prior to the merger, we were rated A- at Mutual Trust with a stable rating. And we were told by AM Best that even though our financials were great, the sales were great, the company was great, they were never going to make us A because we were just too small. Which, that's one of those situations where not only is it a little bit demoralizing, it just kind of pisses you off. Hey, we're doing the right thing, and you're telling us that no matter what happens, we can't get there because we're not big enough. Well, the day after the merger closed, AM Best reached out and changed our A- with a stable outlook to A- with a positive. 9 months later, they gave us the upgrade to the full A. For those of you that have worked with AM Best or familiar with AM Best doesn't do anything in 9 months. They don't get out of their cars in the morning in 9 months. It takes them forever to do those sort of things. So for them to do this so quickly, they saw the value not only in us at Mutual Trust, but being a part of this overall group. The next day, Fitch reached out, and we never had a Fitch rating before. They gave us the A rating just based off of the merger alone. So you've got a company that financially is set. You've got a company with great ratings. What does that mean, though? So you've got this financial strength. What has it meant for us? Well, in 2016, we increased our dividend scale. To my knowledge, we were the only company in the industry that increased our scale in 2016. It wasn't a huge increase, but it was an increase. In 2017, we were able to maintain the dividend scale despite a very challenging interest rate environment. The biggest impact to us was the product development side. Pan American manages all of their assets in-house, and over the last 10 years has averaged better than 100 basis points higher than the AM Best average for all companies in the industry for yield on their portfolio. So this wasn't a one-year thing. This is something they've maintained over the last 10 years. For us, it meant an immediate increase in our new money yield of more than 150 basis points in 2016. Now you look at that and say 150 bips doesn't seem like a big number. When you're talking about a portfolio that numbers in the billions, that's huge. And what we did is we took that new yield, that new money yield, and we put it right back into product. And we introduced 2 new significantly improved products in the first year, Horizon Value and Horizon Guarantee. And we'll talk about both of those in just a moment. What it also did, though, is it drove kind of a renaissance on the sales side for the company as well. In 2016, we increased sales by 16% in an industry that grew by less than 1% in 2016. In 2017, we increased by 22% in an industry that grew by about 2%. In 2018, we were able to maintain our dividend scale again when most of our other competitors, especially our core competitors, decreased their scales. We were able to maintain. And we're now introducing our third new product in the last 2 years. And it's not just a reprice. We've taken our products and we've introduced one brand new one. We've introduced two extremely more competitive versions of products that we had in place before. So we're really excited because product development and putting new things out there for you to talk about is the lifeblood of everything that we do. So changing gears a little bit, when we look at industry trends, when we look at where's the business going, one of the things that we hear when we talk to distributors like yourself is, how do you want to grow and where's that growth going to come from? Because we work in a mature marketplace, and it's a marketplace that doesn't have dramatic, fantastic growth year over year. As a matter of fact, when you look at 2017 alone, the number of policies placed was down 4%. The amount of annualized premiums sold was $14.22 billion, which was only a 1% increase over the year before. And if you go back 10 years, we're still not back to the levels of premium that we were writing in 2007. So if you go back over 10 years, we've actually got negative growth in our marketplace. Face amount increased by $1.72 trillion, so that was about a 2% increase. What concerns me about this, just as an aside, is the only thing that we can control as salespeople is who we talk to, right? We can control how many appointments we make, who we talk to. We can't control how much money our clients are going to have to put into our products. We can't control how much face amount they're going to be able to buy. We can control who we talk to. And if you look, the policies placed is the activity part. That's the part that's down. The part that's really struggling is the one part that we can control. So when we talk to folks like yourselves, what we talk about is, how do you get growth in an environment like this where we're not growing pretty quickly? This next slide shows you what the annualized premium market share by product has been over the last 17, 18 years. And there's some pretty dramatic numbers here. If you look back here in 2000, 36% of the premium that was written in our business was written through variable universal life. 36%. Well, then at the end of 2001, we have the dot-com bubble. Obviously, there's a flight to safety. And what you saw over the next 6 or 7 years was variable UL go from 36% to 12%. But the people didn't go to whole life. They went to UL, down below. UL went from 18% to 42% in 2007. So you think to yourself, all right, there's a flight to safety. What kind of products were they looking at? The majority of those sales were in guaranteed universal life contracts. Those, I give you your premium as long as you pay your premium on time. This death benefit is guaranteed to 121. Has everyone on the line seen or had experience with those types of products before?
Oh, yeah.
Yep. Well, what the clients found when they looked at them is, yeah, I've got a guaranteed premium and a guaranteed death benefit. But look at 2007. UL's at 42%, and it starts a pretty steady decline over the next 10 years. The reason for it is 2007, the financial crisis hits. Not only do the markets go down, but people start losing their jobs. And they discover that, wow, I don't have a safety net in these products. I've got a guaranteed premium and a guaranteed death benefit, but I don't have guaranteed cash value. If I can't pay the premium, my death benefit goes away. And so what you've seen since 2007 is a true flight to safety. 2007, whole life was 22% of the market. It's now 37% of the premium that's sold in our marketplace. Whole life, the product that's been around for 200 years, that's been around longer than anything else. There's been a flight to true safety. Not only guaranteed premiums, not only guaranteed death benefit, but guaranteed growth in cash value and the flexibility that it provides every year. So what does that mean for us? Well, the past is prologue. Everything is cyclical. Whole life, once again, has the highest market share in our industry. Also, macroeconomic events like recessions, like the financial crisis, have a dramatic impact not only on our clients and what they buy and what they do, but it has a dramatic impact on our business. That last slide showed you, after each of those events, there was a dramatic shift in where people were putting their premium dollars. What it also has taught us is that new products like Guaranteed UL, they do provide value, but they also have hidden costs. In a Guaranteed UL, that hidden cost is the opportunity cost of the flexibility. You pay your premium late or you skip a premium payment and your coverage is gone. That's a cost. And then finally, I think this is the point that we're gonna come back to over and over again over the next half an hour, which is that guarantees are always in fashion. Nobody is ever going to be disappointed with a rock solid guarantee in their product. Would you guys agree with that statement?
Absolutely. That's the most important thing people want to hear is what's the guarantee?
Yep. What do I know I'm going to get versus what is possible? So going back to this idea of how do you grow in a low growth industry? Well, one way to do it is to tell a different story. I'm a really big fan of taglines and little phrases that help people remember things. So that first one, a flute with no holes is not a flute, and a donut with no holes is a Danish. Chris, you're not allowed to answer because you already heard this. Anybody else on the call know what movie that quote is from? This is the audience participation part, folks.
I think they're probably all muted.
All right, so if you're all muted, just so you know, that comes from Caddyshack. It's that noted philosopher, Ty Webb, that was played by Chevy Chase. So a flute with no holes is not a flute. A donut with no holes is a Danish. I'll come back to it in a minute, why we put that in there. How about this one? And would this perk up your ears or your client's ears? What portion of you or your client's retirement is guaranteed? Nobody has pension plans anymore. Everybody's funding their own defined contribution plans, and most of that money is not guaranteed. It's going into a 401k. It's going into an IRA that's tied to a market or tied to a separate account. There's no guarantees built into retirement anymore. When you sell whole life and you use it in that way, you actually have the ability to guarantee a portion of your client's retirement, and I'll show you what I mean in a minute. How about this one? The first day of your policy, Mr. Client, is the worst day your policy's ever going to have. If it changes, it's going to change for the better. That's what whole life does. How many times have you sold a life insurance policy over the course of your career and had to come back to the client in year 1, year 2, year 5, year 10 and explain to them why it didn't do what the illustration said it was going to do? We've all had that experience, right? When you sell whole life and you sell it off the guarantees, the first day is the worst day the policy ever has. Worst case scenario every year, you look like you know what you're talking about. Best case scenario is we paid a dividend and the policy got a little bit better and you look like a hero. Wouldn't that be a nice change for those client meetings? How about this one? There's more to whole life than just death. It's not just about the death benefit. As important as that is, it's not just about the death benefit. It's about guaranteed cash value growth and the potential for dividends down the road and all the flexibility and all of the cash value it's going to provide that client and the options it gives them. Life insurance with options. And then finally, the power of renewals. This is strictly for you guys. We still pay a really strong renewal commission on every policy that we issue. Think about that. We're talking about guaranteed ULs up to this point. A guaranteed UL is paid by the client each and every year. If the client's going to pay the premium every year, shouldn't you get paid every year as well? Can I get an amen on that one? Come on.
You can get an amen and a preaching to the choir on that one, man.
I figured. So we're going to talk about that as we go through this. preach, Rev. So we'll talk about where that fits in. So the idea that I want you to walk away with is this concept of fishing the whole pond. How do you get growth in a low growth industry? Find out where sales are coming from. So if you have agents, find out who's writing whole life. Let them know they can do it through you. Or if you have clients that have bought some of those policies before, let them know that they have a guaranteed option through you. Talk to your agents and your clients about the solutions that whole life provides. What sales have you missed, or what sales have clients turned their back on? Maybe not because they didn't like the concept, but they didn't like the product, or they didn't understand it. Not everybody says yes. If they said no, have you ever gone back and asked them why they said no? And maybe it was, I didn't understand the product, or I didn't like this idea of an index, or I didn't like this idea of a variable interest rate. And then finally, for you guys, the power of renewals. How about the ability to not only grow your production now by selling something different and talking about something different, but what you sell today earning revenue for you down the road as well? Wouldn't it be great to start every year not at zero because you haven't sold anything yet, but knowing that you've got $20, $30, $40, even $50,000 in renewal commissions coming in the door? that's a really nice safety net for your practice too. So these are all the things that we're gonna talk about. Any questions on anything that we've discussed so far? Any questions on the company? Any questions on the structure?
No, nothing yet.
Perfect. All right, so let's talk a little bit about mutual trust. You see on the slide that you have the whole life company in quotes, and Chris has one of my cards. That is a tagline that we have trademarked for mutual trust. We are the whole life company. That's all we do. We don't do annuities. We don't do UL. We don't jump into whatever new hot product is coming down the pipe. We do what we do well, and that is participating whole life insurance. So when you look at our portfolio, we have a full portfolio of whole life products. So it's not just a one-fits-all type of scenario either. So we have Horizon Value Whole Life, Horizon Guarantee Whole Life. I'm going to talk about each of those in just a moment. Legacy One, which based off the name, you can probably guess where we market that product. I'm going to talk to you a little bit about our portfolio of paid-up additions riders. Suffice it to say that we can do anything with our whole life portfolio and that paid-up additions rider portfolio. We can do anything that you can do with a UL or an IUL when it comes to cash value. Those paid-up additions riders are so flexible, and I'm going to show you they provide a benefit that none of your companies provide right now that is extremely valuable to your clients. We offer chronic and terminal illness riders on all of our whole life policies. So if your client goes into a nursing home or your client's diagnosed with a terminal illness, they can accelerate their death benefit. And then finally, our newest product is Horizon Blend. That's the one that I'm going to spend the most amount of time on this morning. So you'll just have to bear with me in just a moment. We'll cover that in just a few minutes. So let's start off with Horizon Value. Well, as the name suggests, this is a cash value-driven product. Actually, it provides the best early guaranteed cash values in the marketplace, bar none. Nobody touches us. And in the first 6 years, our guarantees are better than our core competitors' guarantees plus dividends. That's how strong the guaranteed cash is in there. It's also a good solution for long-term cash value. So if you're looking for a retirement supplement scenario, if you're looking for a business plan scenario, this is a great product because it provides unmatched liquidity, access, and control of the cash value. What does that mean? In a whole life policy, there are no surrender charges. So when you're building a lot of cash in that policy, what you see on the page, every dollar of that is available to you. In most of your UL products, especially the early cash ones, they give you that early cash on an illustration and show you what you might have access to. But you can't get at it. If you do, the policy blows up or the company gets angry because even though they're putting an early cash rider on there, they don't actually want you to take the money out. It's really there as an accounting gimmick. And take a look at some of those riders as well. If you try to 1035 out of one of those policies using that early cash rider, 1035 exchanges are not included. So it's not a true early cash benefit for you. It's just meant to show it on an illustration. With this product, we provide low minimum face amounts and the ability to get best class down to there. So again, if you're looking to build cash and you're in good health, you get to take advantage of every bit of that. And then finally, you're going to hear this multiple times today. It provides not only strong first-year commissions, but better renewal commissions than just about anything you're selling today. And when I say strong first-year commissions, we don't have one of those old-time whole-life contracts where you're only getting paid 52.5%. We have a contract that matches what you're used to getting on your UL, your guaranteed UL, your IULs as well. So that's the product. Where does it fit? Well, as I said before, it's a flexible option for any cash accumulation scenario. Whatever you're looking to use life insurance for, be it retirement planning, be it just a forced savings vehicle, we have an option for you. This is the best product in the marketplace for the infinite banking concept. It's also a top solution for selling systems. So if you've heard of things like Leap or Circle of Wealth, or if you happen to be using any of those, this is one of the best products in the marketplace for them as well. We see it used for college and retirement funding. So for people that are looking to, especially late stage, their kids are getting near college, they're looking to utilize life insurance as a possible funding vehicle, we're a great option for that. We're a great option for retirement planning as well because we have the ability to sit down with the client and say, what portion of your retirement is guaranteed? And let us show you what part we can guarantee for you. And then finally, business succession, business protection plans. This is a great product because of that early cash. You know, a business owner puts money into one of these policies, they got to book whatever they put into the policy. Anything they don't have access to, they book as a loss that first year. With the guaranteed cash value, they have the ability to minimize that loss in the early years and see guaranteed growth very quickly early on. Any questions on Horizon Value and on the cash value scenarios? Oh, I got a word from Anthony. Thank you, Anthony. All right, then let's talk about Horizon Guarantee now. Horizon Guarantee is a little bit different than Horizon Value. The guarantee is therefore guaranteed death benefit. So this is your traditional true whole life contract. It's designed to provide the maximum long-term guaranteed death benefit for our lowest guaranteed premium. What we've done with Horizon Guarantee that's a little bit different is instead of all the cash value being packed in the first year, and in those early years, what we do is slope the guaranteed cash values and we slope the dividends to provide the client with the most flexibility down the road. So there is short-term growth in the contract, but where you get the most impact is 10, 15, 20 years down the road when the client's looking around saying, all right, what other options do I have with this coverage? Those guaranteed cash values and dividends, again, because there are no surrender charges, what's on the page is available to the client right then and there. And again, same as Horizon Value, strong first year and renewal commissions. Horizon Guarantee is a coverage product. It's a product that clients pay for each and every year. If the client's paying the premium every year, shouldn't you get paid every year? So where do we see this used? This is a great alternative to Guaranteed UL. Now, it's going to be more expensive out of pocket than those really, really cheap Guaranteed ULs, but with the cash value growth, we have the ability to show a client within the first couple years that their net cost, the premium they paid in less the cash that they've accumulated, is going to be less to them than a Guaranteed UL, because every dollar that goes into a Guaranteed UL that doesn't have cash value is a sunk cost. You don't get that back. This is a great product for maximum base death benefit and premium flexibility. So we have the ability to show a client 15, 20 years down the road how they can use the dividend to offset premium, how the cash values can be used to reduce pay up the policy, use it as a single premium to minimize, bring the death benefit down but have that guaranteed for life. All these different options. It's a great automatic savings plan for younger clients. If you have young business owners that are just starting out, we have a concept that we can show you with this that not only provides a death benefit that grows as their business grows over time, but provides them with flexibility down the road to help fund their retirement, help provide an additional source of income. It's really powerful. Anybody on the line that deals with older clients that's taking required minimum distributions, this is another great option for that because those clients don't need that money. So we have the ability to take that RMD that they've said they don't need, provide them with a death benefit and all the flexibility that goes along with it. And then finally, if you're just looking for a coverage option for older clients, this is especially competitive over age 55. Any questions on that? Excellent.
Actually, I have a question, Luke.
Sure, go ahead.
Hey, is the underwriting the same for all of these products?
Yes.
Okay. Now, is this a simplified issue type of underwriting? Is blood required? How's that process? I mean, without getting
no, this is it's full underwriting. These are all fully underwritten products. The minimum face amounts are going to vary depending upon the product, but our minimums are either can be from anywhere from $10,000 on the cash value product where you're minimizing face amount to $100,000 on the new product as the minimum. And our average face amounts, depending on the product and the concept, can be anywhere between $100,000 and $750,000.
Gotcha. Thank you.
No problem at all. Thank you for the question. So talk about Legacy One really quickly. This is a true single premium whole life that, as the name suggests, is used for legacy building. This is for those older clients that have a sum of money sitting at the bank or sitting in an annuity that they're never going to use for themselves. they want to leave to their kids. So we show them how single premium whole life provides them not only an increased guaranteed death benefit, but guaranteed cash value that they have access to at any point in time if there's an emergency. We issue this to age 85, so it covers just about any client that's looking to create a legacy. And it's a great solution. If you've sold annuities in the past, you know that you've got clients who have money sitting at the bank that no matter how good the offer you have is, they never move that money. And it's because they know that the money at the bank is always going to be there. Well, this product has the ability to not only give them access to the majority of that money, more than 96% of it in the first year, it also has the ability to maximize that death benefit for them. So it's a great option if you've got clients that know they're going to leave that money to their kids, but just don't know what to do with it.
I have a
so
question,
if you don't, sure, go ahead.
On the cash value on the single premium one, is it after the year one that you have access to that initial cash value?
So the way that whole life works is once the money goes in, you have access to it at any time. Now,
So
keep in mind, yeah, you do. Whatever the guaranteed cash value is, you have access to it. At the end of year one, depending on the product and the way that we structure it, you're going to have access to from 90% to north of 96% of the money that you paid in that first year. Now, keep in mind, if the client puts money in and then immediately takes it out, that's going to impact the policy a little bit, and it could also potentially impact your commissions. If there's a withdrawal in the first year, that is going to be a chargeback to the agent. So one of the things, what's that?
She said he had her lifting.
We've got some background noise. If anybody who's not asking a question could just mute your phone, that would be wonderful, please. Thank you.
Thank you. So that just the point being that if you've got a client that's looking to put money into it but thinks that they might need access to a portion of it, just don't include that as part of the single premium is the best way to avoid it.
Right.
Does that make sense?
I guess my question is this, because part of my sales is I thought I sort of figured out how to sell the single premium is that, well, let's say, just example, let's say the policy is $50,000 for the $50,000 face amount. And let's say, I'm just going to throw the number in there. Okay. So let's say the cost of it is $20,000 for the single premium. And immediately they have $15,000. So immediately in my head, well, if they have immediate cash value of $15,000, which means that the policy for this $50,000 only costs $5,000 in my head. You know what I mean? I said, yeah. So
you're absolutely right. And yeah, so the way when we do it as a smart money scenario, the way it works is your client really by the end of the second year into the third year is going to have access to 100% of the money that they paid into the policy. So by the end of the third year, the policy really didn't cost them anything. It actually increased their net worth because of the growth in cash value. So I see where you're coming from. It's one of our most powerful concepts, and it's one of our most successful ones, especially for agents that are new to the company. And we've already talked with Chris. We're going to be going, over the course of the next few months, we're going to have the opportunity to talk to you about different sales concepts and different ways that you can take this portfolio and use it.
We have quite a few things that we want you to show us, and I know that one of them is coming up in the next couple of weeks. We talked about it. You'll talk about it again when we talk about this next product. So, and then we'll have some specific training available for more deeper concepts on these things. But we want to more get it back towards the product. So if you want to go ahead and pull it to the final product here, we'll buckle up and get ready for this amazing show.
Absolutely. Just a couple of quick things on the riders. So when I talked before about that concept of, what portion of your retirement is guaranteed, one of the benefits of whole life is waiver of premium. And when we talk about waiver of premium, that's true waiver of premium. So if your base policy is $5,000 in premium, the client becomes disabled, we waive $5,000 in premium. What that means is we're contributing that $5,000 year after year. If you go and you look here where we have our paid up additions and at the bottom the disability benefit rider, what it also does is if a client's packing cash into their policy, they're doing that through a flexible premium paid up additions rider. Not only can we waive the base policy premium, we can continue to contribute on top of that base policy premium up to $15,000 a year in additional contribution to the policy. So you think about it in terms of a client's funding their policy for retirement. If they become disabled and they don't have something like that on the policy, their retirement, their plan that they put in for this policy isn't going to come to fruition because there's no more contribution. With whole life, we have the ability to not only protect them with a death benefit and provide that cash value, we have the ability to ensure their contribution is made every single year. Think about how powerful that is. So to Chris's point, though, I'm going to skip through the riders and get to the last product in the portfolio. And we'll come back over the course of the next few months and do some more training on everything so that you have it. But we're really excited about the new product because it's a little bit different than anything you've seen in the marketplace. So Horizon Blend, again, the name, Horizon Value is cash value. Horizon Guarantee is guaranteed death benefit. Horizon Blend is a blend between whole life and term. So what we do is we blend 50% whole life and 50% term, and we guarantee the death benefit for the first 20 years on that policy. So what we're able to do is provide you with a maximum death benefit for your absolute lowest out-of-pocket cost. So it's a way for you to take advantage of the benefits of whole life, but blending in the cost savings of term. The dividends on the whole life portion can purchase paid up additions and allow the whole life portion of the death benefit to grow, as whole life does. After 20 years, if the client doesn't want to convert that term rider, doesn't want to do anything with it, then the initial whole life death benefit, the initial $50,000, plus whatever the paid up additions have bought, is what continues on to age 121. So the client has 20 years to decide what to do with that term rider that's on the policy. They can convert it at any time to a full whole life policy up to age 70. So throughout that 20 years up to age 70, if they decide, yeah, you know what, I want this death benefit to continue beyond there, they do the conversion. It's a non-med conversion. There's no underwriting involved. And guess what? When the client converts the policy, it goes to a new whole life policy. You as the agent get full first-year commission on the new whole life policy and all the renewals that are associated with the new whole life policy as well. So not only is it a benefit for the client, that's a great second sale for you too. Does that make sense?
It sounds like it makes dollars.
Amen. So here's some nuts and bolts. Issue ages are 18 to 65. Minimum face amount is $100,000 on this policy. There's 4 bands, so you do get a volume discount as the face amount goes up. And we have all of our rate classes, including preferred best, available at every one of those bands. In terms of features, we have a chronic illness rider on the whole life portion of the death benefit, so that 50% for anyone who's table 4 or better. There is a single premium paid up additions rider for 1035 exchanges or dump-ins. So if a client has some money in a policy that might be underperforming, they can 1035 that into this and seed the pot, so to speak. We also offer a flexible premium paid up additions rider. So if the client says, hey, down the road, I might want to contribute some more premium into this, help build the cash a little bit quicker, we have the ability to do that for them. But because this is the blended product, my advice would be don't go with the paid up additions rider. If the client has more cash they want to put in, convert that term rider and give them all the benefits of a full whole life policy. They can convert that term rider in parts or in whole, so they don't have to do it all at once. They can do it in segments if they want, as long as they're meeting the minimum for the plan that they're converting to. And then finally, again, full first-year whole life commissions and renewal commissions. So you may be familiar with blended products where you blend in the term, but it lowers the commission on the product. We pay you full whole life commissions on the whole life premium and the term premium in this product because it's blended into one. So you're getting whole life commissions even though it's a term premium, and you're getting whole life renewals even though part of it is a term premium. This is an annual premium policy, folks. If the client's going to pay the premium every year, you should earn commission every single year. So how does it work? Well, let's take a look at a 35-year-old preferred non-tobacco $500,000 in death benefit. So the premium is $2,528. That guarantees the $500,000 in death benefit. You go down through this chart and you can see that the guaranteed cash value grows over the course of the lifetime. So you get to 20 years down the road. Premium's $2,528 for that last of the 20 years. By that point, you've got $45,000 plus in guaranteed cash value 20 years down the road, the client can elect to take that out if they want, or they can let it ride at that point. If they haven't done anything with the rider, in year 21, you see the guaranteed death benefit drops to $250. But look at the increase in guaranteed cash value in just that 1 year. So the premium drops as well because the term has fallen off. But that $2,290 now paid for an increase of more than $3,500 in guaranteed cash value increase. And it paid for the death benefit.
Hey, Luke.
Yes.
So, real quick, a quick question. Let's say
Sure.
they want to elect to drop that 20-year when the 20 years finish. They elect to keep that $250,000 death benefit off. Can they Can they at least keep that same premium funding the original base whole life policy, so that way their cash value can grow even more aggressively?
Oh, absolutely. All we'd have to do is if they want to do that, we have to make sure that they add that flexible premium paid up additions rider.
Gotcha.
And then they'd have the ability to continue to contribute at the same amount. That's a you know what? That's a great idea. So I added year 30 there just because we're talking about a 35-year-old. 30 years down the road, that 35-year-old's 65 and maybe looking to retire. He's paying $2,290 in premium. He's got guaranteed cash value of $86,163. And let me show you now what that cash value can do for him. So a couple of points on this growth in cash value. By year 12, the growth in cash value exceeds the premium paid. So in the 12th year in this one scenario that we're looking at, that $2,258 that they were paying or 25, what was the premium number? I'm losing my mind. $2,528, excuse me. That $2,528 that they were paying is now not only funding the death benefit, it's funding an amount greater than that in increase in guaranteed cash value. That is written into the policy. It's not dependent on an interest rate or an index or anything else. Guaranteed. For this product, that's going to happen between years 10 and 17 in most scenarios. By year 20, the cumulative premiums paid are $50,950. Their guaranteed cash value is $45,628. That's about 90% of what they paid in, available to them in year 20. Year 21, we talked about what happens and the increase in guaranteed cash value. And by year 30, they've paid $73,850 in premium, and they've got guaranteed cash value of $86,000. So 30 years down the road, this client retires and they say, you know what? This policy did for me what I wanted it to. It protected my family, protected my income, but I'm done. I don't want this anymore. They can cancel the policy and get every dollar back plus, guaranteed. Now, what have I not talked about at all in this so far? Dividends. Everything I've been showing you is fully guaranteed. We haven't even talked about dividends. And, the fact that this is the guaranteed part, if anything changes, it changes for the better. So what are the options for the client at this point? Well, if they want to maintain the death benefit, they can convert their term rider. They want to stop paying premiums and still leave a legacy, they can take that cash value, that $86,000, and elect reduce paid up. And they'll have about $187,000 in guaranteed death benefit the rest of their life they never have to pay for. What if they need access to the cash? This is a whole life policy. There are no surrender charges. They can access that cash value at any point in time. And then finally, they want to walk away, they can surrender for value. So where are we looking to market this product? Well, the upper left corner here, low-cost long-term guaranteed death benefit, that's the guaranteed UL market. Upper right-hand corner, clients looking for a forced savings aspect. Hey, I'm going to pay this money into my policy, but I want to get some cash value as well. What about maximum permanent death benefit with long-term flexibility? Hey, I want to maximize my death benefit, but know that I can change it down the road. This works. And then for clients who just say, you know what, I don't want to put a bunch of money into a policy that has a bunch of zeros in the cash value column all the way down. I want the benefits of permanent insurance, but I want it on a budget. That's what this does for them. So let me skip ahead of this and just, Chris, do I have a minute to just go through the GUL comparison, or do you want to do that at a different time?
I think you have as much time as you want, even if we go over by 15. I'm okay with it because the training is quality. People can drop off if they need, but you go as long as you're willing to stay with us, my friend.
Wonderful. Thank you very much. So let me give you an example. We talked about guaranteed ULs, and a couple of the folks on the phone acknowledged that they've seen or sold those products before. And this isn't to bash the product. It's a good product where it's designed to be good. But what we've done in our marketplace is taken it and applied it to everybody. And that's not always a good thing. So remember before, I talked about that whole idea of a flute with no holes is not a flute and a donut with no holes is a Danish. This is what I'm getting at. At the top of every guaranteed UL policy is this phrase: flexible premium, adjustable life. That's the description, the legal description of every UL policy that's ever been designed. But in a guaranteed UL, can you skip a premium payment? No. You skip it, your guarantee goes away, or the policy lapses. Can you make a mistake? Can you forget to pay a premium, or can you pay it late? No. If you pay the premium late, either the policy lapses or the guarantees drop way down. What about changing the premium? You can't. If you try to pay less premium into that policy, the policy will lapse. And what about adjusting the death benefit down the road? A guaranteed UL and being able to guarantee $1 million in death benefit for a 45-year-old is great, because no matter what happens to that client, they pay the premium, they know they've got the death benefit. But fast forward 20 years. Now their kids are out of school, their house is paid for, they don't need to protect their income, they've got $1 million in death benefit that they're paying for that maybe they don't need anymore. Well, in a guaranteed UL, you can't reduce the death benefit. Every company will tell you they'll do it as a company practice, but in reality they can't. And it's because you've paid so much premium into that policy, if you reduce the death benefit, you're violating 7702. It's no longer life insurance. If you don't have cash value in the policy, you can't adjust. So if the policy isn't flexible, if it's not adjustable, why is it called universal life? It's essentially just a term policy to age 120. So let's take a look at how Horizon Blend compares against three very competitive guaranteed ULs that are in the market. We're going to call them GUL 1, 2, and 3. It's kind of like a Dr. Seuss novel. Names are changed to protect the innocent. So in this, we're looking at our same scenario. Male 35, preferred non-tobacco, $500,000 in death benefit. Premium is $25.28 on Horizon Blend. Premium on GUL 1 is $24.35. GUL 2 is $27.90. GUL 3 is $30.35. So right off the bat, you see that Horizon Blend is at a price point that is competitive with the best guaranteed ULs in the marketplace. So let's look at some of the other features that come along with it. What about cash value access? With Horizon Blend, you have it at any time. With the other products, you don't, because you don't have any cash value buildup. Now, one of the products offers a return of premium feature. So in years 15, 20, and 25, you can surrender the policy and get back in year 15 60% of your premium. In year 20 or 25, you can surrender and you get back 100% of your premium. That's a great feature. I'm never going to knock something like that. But life doesn't happen on a schedule, right? Life kind of happens. So that's great if when you need the money is year 20, but what if you need to get at it in year 18? What if you need to get at it in year 23 or year 12? In that product, you are SOL because there is no cash value buildup. In Horizon Blend, you have access at any time. Plus, in year 15, you've got 79% of your premium in guaranteed cash value. Year 20, you've got 89%. Year 26, you've got a full ROP. But you've also got access throughout at any point in time. So if it happens in year 14, you've got something you can access. Year 22, you've got something you can access. And then what about that death benefit flexibility? Well, we talked about it before. You can reduce pay up the Horizon Blend when this client turns 65 and have $187,000 in death benefit that you never have to pay another dime for the rest of your life, guaranteed. You can't do that with any of the other products. Again, if it's not flexible and it's not adjustable, why is it called universal life? A flute with no holes is not a flute. A donut with no holes is a Danish. I still love that line.
Mic drop.
So So what's the real flexible premium adjustable life? Well, what if you want to skip a premium payment? Well, with Horizon Blend, you have non-forfeiture options and dividends built into the policy that protect the death benefit. So you can use the dividend to offset the premium or down the road pay the premium. In a long-term guaranteed UL, you cannot skip a premium payment. What if you want to reduce the face amount? In Horizon Blend, you can elect reduce paid up. You can't reduce the face amount in a guaranteed UL. What if you want to stop paying premiums altogether? Hey, I still want the death benefit. I just don't want to have to pay for it anymore. Well, you can pay from policy values using Horizon Blend. You don't have that option in a long-term guaranteed UL because there is no cash value. And here's something that whole life does that nothing else does as well. If your client elects to have a premium paid from policy values, and it's in the first 10 years, you get paid a renewal commission on that premium payment. The client hasn't stroked a check. Nothing new has come into the company. We're paying the premium out of values. You get a renewal commission. So one of the scenarios that we can talk to you about when we talk about single premium sales, we have a single premium scenario that we use a lot where the agent earns renewal commissions every year. When's the last time you earned a renewal commission off of a single premium? I'll help you out. It's probably never. That's an opportunity. What if the client in this scenario wants to take income? Hey, this has been great, but I need to start pulling some money out. You've got withdrawals and loans with Horizon Blend. You don't have that on a guaranteed UL. Here's my favorite one. What if you want an exit strategy? What if 20 years down the road, the client looks around and says, the house is paid for, the kids are out of school, I don't need to protect income anymore, I just want my money back. In Horizon Blend, you can surrender for value and guaranteed get back every dollar you paid in and then some. The only way you get anything out of a guaranteed UL is if you keep paying the premium or you die. Horizon Blend gives you the ability to give your client guaranteed death benefit, guaranteed premium, all of that flexibility, and the ability to get out of the policy alive. Guaranteed UL doesn't give you that. So what's the real flexible premium adjustable life? Let's take a look, though, too, at what is the opportunity lost in this case of selling a guaranteed UL versus looking at Horizon Blend. Well, you can see here's the premiums for two of the ones we talked about. Horizon Blend, $25.28, the long-term guaranteed UL, $24.35. Both of them give you a $500,000 death benefit. Now, granted, Horizon Blends is for 20 years, and it'll drop off after that if you don't do anything. But you've got $500,000 in guaranteed death benefit for that 20 years. Now look at what else you get with Horizon Blend. You get guaranteed cash value growth of $45,628. In the long-term guaranteed UL, for you to match that guaranteed cash value, you would have to not only pay the $24.35 in premium, you would have to take an additional $1,314 every year and put it into an account that's paying you a guaranteed 5% tax-free. I don't know of anything right now that does that. So what's the opportunity lost? The opportunity lost is $45,000 of guaranteed cash value growth and the dividends. We haven't talked about dividends up to here. By year 20, we paid a dividend for 109 years. Pretty sure we're going to pay one next year and probably for the next 20 years as well. If we do, that guaranteed cash value growth is the worst case scenario. If it changes for the better. What's the opportunity lost? You're paying roughly the same premium. You're losing out on all of that guaranteed cash value, all of that dividend growth, and all the flexibility that it provides. So what's the opportunity lost for you as the agent? Well, let's assume that you have a Horizon Blend and a guaranteed UL that have the exact same premium amount. So we're going to try to do an apples to apples here. Well, the first year commission is going to be the same. If you've got a 90 with your other company, you've got a 90 with us. Same thing. Look at the difference in renewal commissions on just one policy. 119 a year versus 23 a year. Here's the first rhetorical question of the day. Which one would you rather have? But one policy does not a producer make. we're looking to give you something that you can use to build some business off of. So let's assume that somebody writes 10 of these a year for 10 years. Okay? 10 a year is less than one a month. You write 10 of these a year for 10 years, and let's just say they're all the same premium just to keep things equal. Well, the first year commission is going to be the same. Look at the difference in renewals. Over the course of 10 years, just on this one little sliver of your practice, you're going to earn close to $60,000 versus earning less than $20,000. Which one of those would you rather have? That's the power of renewals. If the client's going to pay the premium every year, shouldn't you get paid every year? So what are some other opportunities for additional revenue? Well, you can add the waiver of premium like we talked about before. Create a self-fulfilling plan for the client. You're creating value for the client. You get paid for the waiver of premium. You can convert the term rider. We talked about that. You get full first-year commissions and renewals. Cash values in the build-up in Horizon Blend, cash values always improve the possibility of future sales. And then here's the last thing I would suggest. If you're going to talk to a client about this, they might say, gosh, I like it. I just don't have the money for it right now. We have a term portfolio that's fully convertible. So if you can't afford it right now, let's get you into term. And then when your cash flow improves, we can get you into whole life. Now, full caveat here, Horizon Blend isn't available for conversion because 50% of it's term, but that term policy can be converted into any of our whole life products in the portfolio. That's an additional sale. So let me just fast forward real quick. The last thing I would mention to everybody is because we're an old whole life company, we still do a first class agent convention every year. And for a first-year agent, it is the easiest thing in the industry to qualify for. Not only are the qualifications low, the first 4 months that you're contracted with us, anything you pay for, we give you double credits on. Wow. So if anything that we've shown you here is of interest, and so Berlin, this is the one that qualification period ends in December. So this will be a little bit of a tough one. But we're going to be announcing our next trip in January. Just to give you an idea of some of the places that we've taken people, Berlin is 2019. This past June, we were in Sydney, Australia. The year before, we were on Kauai and Hawaii. Over the last couple of years, we've been to Ireland, we've been to Portugal, we've been to Costa Rica. We go to some pretty sweet spots. So
what are
if you've
the qualifying parameters for that, Luke?
We will get all of that out to you, Chris. It's for a first-year writing agent, it's $35,000 in what we call new business credit, which is roughly $70,000 in target premium. Our average case size is about $4,000. So it's basically if you write 2 cases a month, you qualify for our conference in that first year. And it can be even less than that if you get the double credits on it. So truth be told, year 1 is really easy. We bump up the requirements in year 2, and then we bump them up again in years 3 and beyond because we want you to come, we want you to have a blast, and we want you to come back. So we're going to make it a little bit harder.
Luke, I have a question, please. That's
yes.
Amazing, by the way. I'm drooling over here. Honestly, I've never, I'm still pretty new, and I'm not familiar with, what does I know you can't guarantee this, the dividend, but what does it usually look like? So I have some ideas, So we do a lot of paid up additions business along with our base whole life portfolio. So when you run a cash value scenario, for example, if you're doing paid up additions, which we do a lot of, that brings the dividend down a little bit. What we tell people is our guaranteed interest rate on our products is 4%. That's a gross rate. So when you take out expenses and things like that, it's going to be high 2s probably is what you're going to see in guaranteed cash value growth. Long term, with the dividend on top of it, you're going to see a return somewhere between 4 and 5.5% overall in your whole life product. That's not as spectacular as what you get on an IUL, but you're also never going to have a year at 0. Right.
That cash value grows each and every year. So where we position it is sell this off the guarantees, and then the dividend becomes that happy surprise every year that just makes it do a little bit better. The other thing to remember, and this does not apply with other products, a whole life policy gets better every single year. Not only the guarantees, the dividend. Because remember, we spread the dividend over how many policies stay in force. So if somebody lapses their policy or cancels their policy, the dividend that would have been paid to them goes to the policyholders that are still there. A whole life policy gets better every single year. You can't say that about a UL. You can't say that about an IUL. Did I answer your question, or did I avoid it appropriately?
So you're saying so approximately it's about that. Did you say it's about maybe 2% additional?
Depending on the structure, of the policy, and depending on which product the client goes into. What we tell folks is all in, it's going to be somewhere between 4 and 5.5% long term is your return.
Okay.
But we're talking about having 4 or 5% annually, whereas the comparison is on a UL, you're getting, maybe 8 or 9% 1 year and then a 0. And then you're getting, out of 7 out of 10 years, you might get some gain, but the zeros or the losses are going to create setbacks, whereas this just has a steady growth, whereas both steady wins the race. And if it's a 5% or a 5.5% gain, I mean, that is competitive long term. When you look at having 2 or 3 or 4 years out of 10 at 0, it does make a big difference. And I've seen the illustrations to prove that long term. It stacks up against a UL very competitively with higher guarantees, with cash flexibility, and with price point that makes sense comparative to some of the other ULs that have, the most contributions for payment to get to those accumulation levels. This is a steady payment. So I think.
And the other thing I'd add to it, Chris, to your point, is it doesn't have to be an all or nothing scenario. If the client wants the benefits of an IUL, split the money in half. Put 50% into an IUL, and you've got a part that will grow when the markets are doing great. You put the other 50% into a whole life, and you've got a part that's growing each and every year. And then when you add waiver of premium and the disability benefit rider, you've also got a part of that plan that if you become disabled, becomes self-fulfilling. Nobody else can do that.
And that's for as long as they are disabled?
It's a waiver of premium and the disability benefit rider is essentially like a disability income policy for your life insurance policy. It pays your premium for it and pays the additional contribution up to $15,000 a year.
Right, but I've seen some company where there's only will go up to like 3 years or something like that. Then after that they'll stop. Is it forever or? No, it's a 2. The client has the option of a 2 or a 5 year ONOC they can select, and it's payable through 65. Okay. Thank you.
Mm-hmm. Is there anything else that we can help you guys with? Any other questions that you have?
I want to comment real quick and maybe have you expand on something, Luke. And that's you snuck it in there, but it was a quick little mention, but I think it deserves more focus real quick, which is the term convert option, where you've got somebody who loves this product and they say to you, this is great next year when my income taxes come in, or this is great when, in 4 years I get my promotion, or when my wife's out of school and she's working. All those reasons that people give not to invest in their future today, they want to do it tomorrow. They want to invest in their future in the future, which is so funny to me. But instead, you can say, great, well, we can cover the death benefit aspect. We can cover the insurability aspect. We can get you brought into the company. And then when your plans do change, it's just a matter of, changing over the policy and not of going through all those stages at a later time. And you can get them that coverage now without the heavy cash investing or without the heavy financial attention of getting that cash accumulation started now. But let me ask you this question. Some companies address this differently. When you convert a policy, you said you pay the agent again, which is great. Is it guaranteed insurability? Is there a window of that? Is there not guaranteed? And then also, how does it work is there any credit for previously paid years of the policy or any of those things like that?
Okay, so with our term portfolio right now, and we're in the middle of repricing the portfolio, we'll have a new term portfolio available to you in the first quarter of next year. Right now, it's convertible through age 65. With the new portfolio, it'll be to age 70. It's convertible to any full whole life product in the portfolio. So we can't convert to the Horizon Blend because it's already 50% term. So you can't convert term to term. But Horizon Guarantee, Horizon Value are both available for conversion. It is a guaranteed convertibility. So as long as they are within the age range, and as long as you're meeting the minimum face amount for those products, you can convert without evidence of insurability to any of those products. And here's a little niche that very few have, and this is an old-time whole life trick. We talked about waiver of premium. If you have waiver of premium on a term policy, and that client becomes disabled, and the policy is being paid through waiver of premium, they can convert the term policy to whole life, and the whole life policy will be paid through waiver of premium. Think about that.
Can you say it one more time, sir? I'm sorry.
Sure.
So
you put waiver. Let's say you sell. Let's say you've got a 35-year-old new business owner, and he needs coverage just to protect that business, but he doesn't have a lot of cash flow. So you take a 20-year term policy out on him for $500,000. He's paying into that policy, and you add waiver of premium to it. Client becomes disabled a couple years later. God forbid he has an accident, something happens to him. So now the policy is being paid by that waiver of premium rider. He can convert his 20-year term policy to a whole life policy that will last to age 121. And even though the term policy is being paid through waiver of premium, we will now allow him to convert and then pay the whole life policy with waiver of premium through age 65.
Oh, wow. Okay.
That's huge.
That is huge. And does that mean that if somebody converts to a whole life plan, can they then down the road convert to the blend from the whole life? No,
the blend isn't available as a conversion option because it's 50% term. It kind of is what it is. It's meant to be the low cost option.
Okay, so
but
if you want to get
the other whole life options.
Got it.
Yeah.
Yeah, that's crazy. But you guys, I see, there's a lot of people sending me text messages. I had one guy send me a message about 10 minutes ago, Steve. He said, when's the recording link going to be available? I need to see this again immediately.
I will. It'll take a couple hours for them to put it together for me, but I'll shoot it out to you later today, Chris.
Great. Yeah. I mean, you are generating a lot of thought and a lot of questions and I think people are starting to wrap their mind around how important it is to really understand what traditional whole life policies are capable of, especially when they're run by a company that understands that space and is an expert in that space and is a mutual company at that. So you guys have the best interest of the policyholders in mind. You are giving the agents renewals, and you're giving us ways to recreate new business off of old business where we convert and change policies to help the client through their financial road, however that looks to them. And at the same time, you're giving us the sales techniques and the understanding and the principles to be able to promote the product properly. I just love this partnership, and I want to thank you for your time. And even though I'm sure we have a bunch more questions, I don't want to hold you for the whole day. So I will let you have about 5 more minutes to close us out here with any parting really awesome things that you can tell us or any teasers for the next webinar. And maybe if we're going to do that next Friday, we can go ahead and just lock that in. But because we did talk about that, I'm not sure what your schedule was. But I'll go ahead and hand you the floor.
Well, first of all, let me just say thank you to everyone for giving us some time. We truly know how busy you guys are and how valuable your time is. So we try to respect that. What I would ask of the group is the reason that we kind of went through the whole story and talked about the whole portfolio, we focused on the new product, is I want you to take a look at this as not just, another product I can add to my offerings. When you factor in the renewals, when you factor in the flexibility and what these products can do down the road for your clients, we believe that whole life and mutual trust in particular can be a foundation piece in your practice. we're not going to ask you to stop doing what's made you successful at all. We're going to show you ways that we can add to your production, that we can increase the size of that pie. And we're going to show you ways that we can do that help you generate revenue down the road. So what I would ask is, don't look at us just as another product. Talk to us about how we can become that foundation piece, how we can become a source of income down the road, how we can become a fantastic trip that you can count on taking every year by writing business, that additional award that you get. I would love to do a webinar next Friday. Chris, what I'm going to ask you and Kip to do is to kind of catch up and talk about what a schedule for training is going to look like going forward. What kind of concepts you want to focus on. We've got a lot of different things that we can work on. So if we want to reserve this time, Kip, does this time next Friday work for you?
Yeah, absolutely.
Excellent. So, Chris, we'll put it on the calendar. I don't know if I'll be able to be in on all of them, but you're in great hands with Kip. He is our reigning regional vice president of the year at the company. So you guys are also in the presence of royalty, huh? Yeah. So I'll leave it to you guys to decide what the schedule looks like. We are available anytime for questions, for anything that you need. The first step I would ask of anybody that's interested is, let's figure out if you've got some clients you want to talk to, and let's write that first app and submit the first app along with your contracting, unless you're in a wait state where you have to be contracted first. But if you wait and submit your app with your contract, then you get to take advantage of that 4 months of double credits.
Yeah, that's true. That's a fantastic point. Everybody make sure that you take advantage of that, because double points means if he's saying you need about 70,000 in target, then that kind of means that really you need about 35 or 40,000 in target with double credits to hit that trip. Is that what you're saying?
That's what I'm saying. And you've only got 4 months to do it in. So we want you to get up and going, and we want you to get up and going quick.
Oh, wow.
Well, sounds like $10,000 a month is doable when you have about a $4,000 average premium. So,
amen.
That's two a month, man, 2 a month. So we'll start with the first one. But guys, listen, thank you for spending extra time on the webinar. I know it ran long, but I think this was a very important one, and we'll have another one coming very soon. And a new concept that we're going to be introducing to you. We'll make sure that we get some information out about it next week. And fellas, thanks again for getting on here for us. It means the world to us, and we love your partnership, and we can't wait to build the product base out here for you in the market.
Wonderful. Thank you so much, Chris, and thank you to everybody on the call.
Thanks a lot.
Thanks,
guys.
everybody.
Have a blessed day. We'll see you at the 4 o'clock webinar, everybody else. And guys, thank you for your time. Take care.
Take care.